When you think about the most successful candy brands in American history, Lifesavers almost certainly comes to mind. That small roll of mints with a hole in the middle became a fixture in pockets, purses, and checkout lanes across the entire country. But what most people don't realize is that this iconic candy tells us something far more important than just a story about sweets. It tells us the story of how modern capitalism works, how financial decisions can destroy even the most successful companies, and why understanding capital really matters in the world we live in today. The story begins over a century ago with a simple idea and an entrepreneur named Clarence Crane. In 1912, Crane created a mint candy with a hole in the center. He called it Lifesavers, and the name stuck for good reason. The candy was affordable, easy to carry, and delicious. But Crane understood something that many business people miss. A great product needs great distribution. That is where Edward John Noble entered the picture. Noble was a genius at getting products into people's hands. He bought the rights to Lifesavers and completely transformed how the candy was sold. He understood that if you could place a product right next to the cash register, people would buy it on impulse. He knew that high-volume sales, even at low prices, could create enormous profit. The model was straightforward. Keep production costs low. Turn inventory over quickly. Generate steady cash flow. This simple formula worked beautifully. The business grew and grew. Factories expanded. Equipment got upgraded. More workers were hired. By the middle of the 20th century, Lifesavers had become part of the fabric of American business. Eventually, larger corporations bought the brand. First it went to Nabisco, then it ended up under the Kraft Foods umbrella. The candy was more successful than ever. But here is where the story takes a crucial turn. And this turn reveals something that most people do not understand about how modern corporations actually work. When companies change hands, and when they get folded into larger corporations, the financial structure changes dramatically. Suddenly, the company is not just making candy anymore. It becomes an asset on a balance sheet. It has to justify its existence in terms of return on invested capital. This is where debt enters the picture, and debt changes everything. Think about it this way. Imagine you want to buy a house. You have enough money to pay cash, but instead you decide to borrow 80% of the purchase price. This works fine as long as your income stays stable and predictable. You make your mortgage payments on time, everything is good. But now imagine your income drops. Maybe you get fewer hours at work. Maybe the economy slows down. Your mortgage payment stays exactly the same, but you have less money coming in. That creates real financial pressure. That is exactly what happened to the Lifesavers plant. When corporations merge or acquire brands, they frequently finance these deals with borrowed money. This is called leverage, and it is a fundamental part of modern finance. Leverage amplifies your gains when times are good. It amplifies your losses when times are bad. Under these new corporate structures, the Lifesavers plant was no longer just a place where candy was made. It became a line item on a spreadsheet. It was evaluated as an asset. It had to generate a certain return on the capital invested in it. Everything changed in how the business was evaluated. By the late 20th century, the economic environment around the candy business started shifting. Imported candies became cheaper. Private label brands started competing more aggressively. Labor costs rose across manufacturing. These were real pressures, but they were not the main problem. The main problem was leverage and how it squeezed the plant. Under the new corporate ownership, margins started getting tighter. The plant needed modernization and new equipment, which required investment. But instead of reinvesting heavily in the facility, the company allocated capital elsewhere. Meanwhile, the debt payments that had been taken on stayed exactly the same. Revenue fluctuated up and down with market conditions. The cash flow available to the company started shrinking. The plant was caught in a squeeze, and financial pressure was mounting. Then came a turning point, and this is where the story becomes really important for understanding modern capitalism. In the early 2000s, the corporate owners of Lifesavers began consolidating their operations. They looked at every manufacturing facility they owned and evaluated it through a single lens. What is the cost per unit to make this product? If another factory or another country could produce the same candy for less money, why keep paying to maintain an older plant with higher costs? This is where sentiment disappeared and spreadsheets took over. Executives no longer asked questions about tradition or brand heritage or worker loyalty. They asked mathematical questions. What is the return on assets? What is the operating margin? What are the debt servicing ratios? Can we deploy capital more efficiently somewhere else? The Lifesavers plant had high fixed costs. It had pension obligations to workers. These were long-term liabilities that showed up on the balance sheet as expensive. The executives made their decision. Production would move. Not because Lifesavers stopped selling. Not because Americans stopped buying and eating the candy. Not because the product had failed in any way. Production would move because on paper, on the financial spreadsheet, capital could be deployed more efficiently elsewhere. Factories closed. Workers who had spent decades making candy suddenly found themselves unemployed. The plant that had been an economic engine for its community went silent. And just like that, a once hugely profitable operation declared bankruptcy protection. The irony was sharp and bitter. The candy that symbolized sweetness and stability became an example of something much harsher, the cold logic of modern financial capitalism. But what happened after the plant closed reveals something important about how modern corporations actually think. The Lifesavers brand itself never went away. The candy is still sold today. Production simply shifted to other facilities, many of them in countries with lower labor costs. From the perspective of Wall Street and the shareholders, the strategy worked perfectly. Costs came down. Production became more efficient. Shareholder value stabilized and continued to grow. The company made the right financial decision, according to the metrics that corporations use to measure success. From the perspective of the workers and the community, however, it felt like abandonment. Pensions were renegotiated, often for less money than workers had been promised. Local suppliers lost contracts they had depended on. The municipal tax base shrank because the factory was no longer paying property taxes. A factory is never just a building. It is an economic engine that supports entire communities. When it shuts down, the effects ripple outward in ways that balance sheets cannot measure. This story reveals something fundamental about how capital allocation works in the modern economy. Companies do not exist to make products or employ workers or serve communities, even though they do all of those things. Companies exist to generate returns for their shareholders. Workers matter, but only insofar as they affect profit margins. Communities matter, but only insofar as they affect costs or revenues. This is not a moral judgment. It is simply how the incentive structures of modern capitalism work. In today's economy, every factory, every store, every operation has to generate a return that is higher than the cost of capital used to finance it. If it does not, then it gets restructured. It gets relocated. It gets removed entirely. We have seen this pattern play out again and again in recent decades. Retail chains that seemed permanent have vanished from American towns. Tech startups that looked like the future have suddenly collapsed. Even major financial institutions have had to be restructured or broken up when their operations stopped generating adequate returns. Leverage amplifies growth when times are good. When the economy is expanding and revenues are rising, borrowing money to finance expansion can create tremendous gains. But leverage also amplifies risk. When conditions change, when revenue drops even slightly, the fixed debt payments suddenly become a massive burden. The company gets squeezed. Cash flow tightens. Options narrow. And sometimes, even once successful operations can collapse under the weight of their own debt. The lesson of the Lifesavers plant is that sustainable success is not just about revenue. It is not just about making a great product that people love. It is also about balance sheet discipline. It is about cash flow management. It is about making strategic decisions to reinvest in the business and keep it competitive for the long term. When capital chases short-term efficiency without thinking about long-term investment, even iconic operations can collapse. This matters because these patterns are happening all around us right now. We live in an economy where debt fuels corporate growth. Companies take on leverage to finance acquisitions and expansion. Shareholders demand ever higher returns. Cost-cutting becomes a way of life. And when the math does not work anymore, operations that took decades to build can disappear in months. The Lifesavers story also tells us something about the nature of modern capitalism that we should think carefully about. The brand survives. The product survives. Shareholders probably made money on the restructuring, but the workers lost their jobs. The community lost its economic engine. The pension obligations that the workers had earned got renegotiated. In a financial sense, the system worked well for the people with capital. In a human sense, it worked terribly for the people with labor. There is another angle to this story that is worth exploring. The Lifesavers plant had been incredibly profitable for decades. It generated enormous amounts of cash. But under the pressure of leverage and the demand for ever higher returns, it eventually became unprofitable enough to close. This raises a fascinating question about modern capitalism. If a company that was this successful, that had this much staying power, that had this much brand loyalty, could be destroyed by financial structure, what does that tell us about the foundations of modern business? It tells us that financial structure matters more than we typically acknowledge. It tells us that leverage can be dangerous even for strong companies. It tells us that when you borrow money to finance an acquisition, you are betting that the future will look like the past. You are betting that revenues will remain stable. You are betting that costs will not rise unexpectedly. You are betting that competition will not intensify. If any of those bets go wrong, the debt becomes a trap. The Lifesavers story is also a story about the evolution of corporate ownership. When Lifesavers was a standalone company, the owners had to care about the long-term health of the business because they owned it directly. As it got folded into larger corporations, the connection between ownership and operation got diluted. The plant was no longer owned by the community. It was owned by distant shareholders. The workers were no longer valued as part of a family business. They were valued as a cost to be minimized. This shift from owner-operated businesses to shareholder-owned corporations has been one of the most significant changes in the American economy over the past century. It has created tremendous efficiency and tremendous wealth. But it has also created a system where short-term financial metrics matter more than long-term community health, where returns matter more than relationships, where spreadsheets matter more than stories. When you look at the Lifesavers plant story this way, it becomes clear that bankruptcy was not inevitable. The plant did not have to close. Lifesavers did not have to be restructured. What was not inevitable was a particular financial strategy, a particular way of thinking about capital allocation, a particular decision to prioritize short-term returns over long-term investment in the plant and the community. The question that lingers after learning this story is whether similar patterns will continue. If debt continues to fuel corporate growth, if leverage continues to be the dominant strategy for expansion, if short-term returns continue to be prioritized over long-term investment, then we should expect to see more stories like this one. More iconic brands restructured, more factories closed, more communities disrupted, more workers displaced. The Lifesavers plant teaches us that nothing is permanent in modern capitalism. Not even brands that have been around for over a century. Not even products that sit in nearly every American pocket. The sweetness of success can turn bitter very quickly when financial pressure mounts. And the difference between staying competitive and going bankrupt often comes down to decisions about capital that most consumers never see and never think about. This story is important because it reveals the hidden financial machinery that drives modern business. Most people think about companies in terms of products and brands. They do not think about debt structures and capital allocation and return on invested capital. But those financial decisions matter far more than most people realize. They determine which businesses survive and which ones disappear. They determine where jobs are created and where they are destroyed. They determine how capital gets deployed across the entire economy. The Lifesavers plant story is ultimately a story about power and how it operates in modern capitalism. It is about the power of financial logic to override other considerations. It is about the power of shareholders to demand restructuring even when it harms communities. It is about the power of debt to shape corporate strategy in ways that can be destructive. Understanding this story helps us understand how the economy actually works, beyond the surface level of products and prices and consumer choice. It reveals the financial foundations underneath, and those foundations matter far more than most people think.